All right, good afternoon, everyone. Thank you so much for joining us today. My name is Amanda Sylvia. I'm a paraplanner here at Stonehearth Capital Management, where I've had the pleasure of supporting our advisory team, as well as working on our marketing efforts and compliance for about the past 10 years or so. We're thrilled to have you here with us for today's webinar. We're going to be taking a really close look at the big, beautiful tax bill, which is the newest piece of legislation making waves in the tax and financial planning world. This session is going to be designed to help you sort of understand what's changing, who's affected, and how you can plan ahead and make the most of those opportunities and maybe avoid some of the potential pitfalls as well. Just as a reminder, please use the Q&A button at the bottom of your Zoom screen. You can submit any questions that you might have throughout the course of the webinar, and we will go through them during the live Q&A session at the end of the presentation. Leading our discussion today is David Juliano. He's a senior financial advisor here at Stonehearth. He joined our firm back in 2016. He has over 20 years of experience in the financial planning and wealth management world and industry. He's also a key member of our investment committee. We're fortunate to have David with us today to break down this major legislation and share some practical strategies you can use right away. So without further ado, I'll hand it over to David. Thanks for joining us.
Thank you, Amanda. Thanks very much. And good afternoon and welcome, everyone. Thank you for joining me. Our topic today is the one big, beautiful bill. Now, this, this bill weighs in at about 1,000 pages. Excuse me. So, excuse me, I won't be going through all 1,000 pages. That'll take me all day. And I don't think that any of you want to listen to me talk about taxes all day. However, we will be going over some of the important parts of the bill that we want you to be aware of, and we'll discuss how some of these items in the bill can impact your personal taxes, along with financial planning opportunities to be aware of. So for some quick background, let's talk about how we got here. So this new bill was signed into law earlier this month on July 4th, but for some quick background, looking at where we got here in President Trump's first term, Congress passed the Tax Cuts and Jobs Act of 2017. So that was a pretty significant tax bill at the time, and it served to lower income tax rates, which affected everyone. So there were many other pieces of that bill, but the big thing coming out of that was we all got lower tax rates. So the tax brackets were all brought down a little bit. But most of the important parts of that bill were set to expire at the end of 2025. So it seemed like a date far in the future at the time, but here we are in 2025, and many of those tax rules in that first bill back in that Tax Cut and Jobs Act were set to expire at the end of the year. So what this new bill did was permanently extend a lot of the provisions in that Tax Cut and Jobs Act of 2017. So that's why some people are referring to this as the TCJA 2.0. So we do have some temporary modifications, and we do have some permanent modifications that are part of this new bill. Excuse me. So as we navigate through this list of modifications that we'll be talking about, I would encourage you to kind of consider how some of these alterations may apply to your own personal financial situation and determine if, some actions need to be taken place before year end. And with some other provisions that don't start until 2026 or beyond, there might be some planning opportunities to consider for starting at the start of next year. So let's start off looking at some key parts of the bill that will affect individuals. The first is what we were just talking about, personal income tax rate. So the current income tax brackets that we've been working with since that Tax Cuts and Jobs Act back in 2017, those are now permanently extended. So those are now the permanent tax rates that we'll be working with. So as I mentioned a moment ago, the important piece of that is, had we not had this new bill and those tax rates were set to expire at the end of the year, we'd be going back to our prior tax rate. So we'd have a top rate of 39.6 instead of 37%, which would have been the rates that we saw back in 2017. So instead, the tax rates remain the same, and that top tax bracket remains at 37%. So the important item here from a tax planning standpoint would be that we now have a little bit more certainty for tax planning beyond this year. So this can help with items such as Roth conversions, where things like that, which rely on pretty careful considerations of tax brackets. So this new bill gives us a little bit more certainty on where tax rates will be beyond this year. Speaking of those tax rates, here's a peek at really where we are just for this year in 2025. So these are the tax rates that we have for this year. You can see the individual, each tax rate that's running along the left side of this table, starting at 10% all the way up to 37%. As I said, these rates were all set to go up a little bit at the end of this year. So now we know that these tax rates will stay the same. And then in the other columns of this table, you see the actual tax brackets. So whether you file single or you file married and you file a joint or a head of household, those tax brackets that you see with those individual dollar amounts, those will adjust for inflation as time goes on. But the key piece of this new bill is that there's a initial inflation adjustment in 2026 for the 10 and 12% brackets, the bottom two brackets, and that additional adjustment will basically slightly increase the income thresholds for those brackets. So it really allows for more income to be taxed at those lower two rates, effectively lowering tax rates for most people. Because remember, your income gets taxed up through the brackets. So even if you fall in the 24% bracket or the 32% bracket, the first portion of your income gets taxed up through those brackets. So we don't know the exact inflation figures for that 10 and 12% bracket for next year, but we know that they'll get a inflation adjustment, which will allow more of your taxable income to get taxed at those lower brackets. One item of note here from a tax planning standpoint is under the old law, the Tax Cut and Jobs Act of 2017, there was a pretty small difference between ordinary income and capital gains threshold for us to safely assume that someone in the 12% ordinary income tax bracket would also be in the 0% capital gains bracket. So those of you familiar with tax brackets, you have your income that's taxed at these income tax rates that we're looking at here, but we also have a capital gains tax rate that's different. So for most folks that have their income up to that 12% bracket, you'd fall in the 0% capital gains tax rate, which is something that we can take advantage of. If we know you're going to be in that lower tax bracket, we can realize some capital gains and maybe pay 0% rate on that. What's of note here now is that with the 10 and the 12% brackets increasing a little bit, the thresholds to stay in that 0% capital gains rate, there'll be a little bit more of a spread between where you would stay in that 0% capital gains rate and where you would stay in that 12% tax bracket. So really that's kind of a lot of words to say that it's important to just keep an eye on that. And at Stonehearth, we pay attention to these brackets just to make sure that we're going to optimize how you might recognize capital gains when we have different options to be able to do that. So looking at some other things that were part of this new bill, we also will see an increase in the standard deduction. And one of the nice things coming out of this bill is that increase went right into play for this year in 2025. So if you file your taxes as single or married filing separately, that standard deduction went from $15,000 to $15,750. For married filing jointly, that standard deduction went from $30,000 to $31,500. So we saw an increase in the standard deduction for this year. So early next year, when you go to file your taxes for 2025, these are the new standard deductions that you'll use. So one of the things that we saw coming out of that legislation from 2017, if you all remember, was this big jump up in the standard deduction. And that really kind of made it so that almost 90% of all taxpayers now went to the standard deduction instead of using itemized deductions. Now, we'll talk about that in a minute related to some changes that might make some people go back to itemizing. But for those that will stay with the standard deduction, we saw a nice little increase here, which is great. Now, these amounts will be adjusted for inflation and will be permanent going forward. Now, some of you might remember personal exemptions. So we had deductions and exemptions. Those personal exemptions for individuals, spouses, dependents, those are all permanently removed. So we don't have to worry about those anymore. Now, there is also another part of this new tax bill that brings in an increased deduction for seniors. Now, this is effective beginning this year from 2025 through 2028. And while we're making that point on this particular rule, one thing to keep in mind is, and I'll go over this as I'm highlighting each individual change, is that one of the important pieces of this new legislation is some things are made permanent from the time of this bill, either in 2025 or 2026 going forward. But some items like this will be effective only for a certain amount of years. So we'll be kind of paying close attention to that as I'm going through these slides and talking about different rules that are coming into play. So for this one, it's effective for the years 2025 to 2028. And it's in addition to the standard or itemized deduction that an individual might take. So you have to be age 65 by the end of this year or older, and you can take an additional deduction of $6,000 or $12,000 for those joint filers where both people filing that joint return are over 65. So you're taking that off of your taxable income. The other important note with this is that this temporary age 65 plus deduction is on top of the additional standard deduction that's already given to individuals who are 65 or older, which adds an extra $2,000 deduction for single filers and another $1,600 deduction each for those that are filing jointly. So all that means is if you're age 65 or older, you could have up to $23,750 for a single filer and up to $46,700 for joint filers. So you're starting to see a pretty significant amount of a standard deduction there, which again might force more people into taking that standard deduction rather than itemizing. As we all know, it's a lot more simple to take that standard deduction, but I thought it was pretty notable to say that there's this increased standard deduction for seniors, but it didn't take away that little extra deduction that folks that were age 65 and older were already getting. I think that one important item to note that was a little bit confusing before this bill actually became put into law was there was some discussion about Social Security income not being taxed, or maybe the tax on it would be reduced because of this new bill. So there was a little bit of confusion that this particular provision that has this increased deduction for seniors was specifically applying to Social Security income. But it doesn't do that. So Social Security income and the rules that are governing the taxation of that type of income have not changed at all with this new bill. It was in earlier versions of the bill, but the final version of the bill does not change Social Security taxation at all. The reason why it's somewhat confused with this increased deduction for seniors is that there was a study done about the average amount of Social Security income that most folks get, and that this deduction amount would essentially deduct most of what people get for Social Security income. But that statement doesn't really take into account that this deduction is for all the income that you get, not just your Social Security income. So you might have pension income, you might have other types of income coming in. So the the real takeaway from this is that Social Security income taxation hasn't changed, but for these 4 years, there is a nice increased deduction for seniors that they can take. The other one of the bigger questions coming into the negotiations of this law were the limitations on the state and local taxes, referred to as SALT, the SALT, which was fixed at $10,000 under that Tax Cut and Jobs Act back in 2017, and that's what we've been kind of working with ever since then. So one of the big questions coming into this bill, and it went back and forth between the House and the Senate, was to try to increase that SALT cap at $10,000. So when that state and local tax deduction was capped at 10,000, folks that live in high income tax states or states with high property taxes, those are some things that you used to be able to add to your itemized deductions, which made itemizing a little bit more beneficial. But when those items got taxed at $10,000, it really kind of forced people to go back to the standard deduction because that was more beneficial. Well, now with this new bill, that SALT cap is increased to 40,000. So from 10 to 40. So things that you pay like state income tax and local taxes related to property taxes, instead of that section of your itemized deductions being capped at 10, it can now go all the way up to 40,000. But an important part of this is that SALT cap increase to 40,000 is effective starting this year in 2025, and it goes up through 2029. So when we get to 2030, if nothing changes between now and then, when we get to the year 2030, it's going to go right back down to the 10,000 that it is now. So the important part of this would be just looking at your own personal tax situation to see that even though the standard deduction is going up, and if you're over 65, it's going up even more, you may have enough of these state and local taxes that it may make sense to jump over and do itemized deductions, which once you're in that world of doing itemized deductions, you may be able to bring in some other deductions that come into play there. We'll get to some of those in a moment. So important to just kind of know a couple of things, that it went from 10 to 40 and that it's really only going to be in place until the year 2029. So with that in mind, looking at a couple of other deductions that have changed in this new bill, one of them being charitable deductions. So this provision is effective from 2026 and beyond, and charitable deductions have been expanded to non-itemizers as well. And you'll hear me say this for a few of the next things that we'll talk about, is things that people who don't itemize are able to now take advantage of a couple of deductions that haven't been in place up until now. So this deduction for non-itemizers is available only for cash contributions. So it doesn't apply to contributions of property, like if you're donating stock or contributions to a donor advised fund. So it's only for cash contributions to a charity. And the deductions are capped at $1,000 for a single filer or $2,000 for a married filing jointly. So for example, for charitable deduction for a non-itemizer, if you have adjusted gross income of $1,000 or 100,000 and you donate 1,000, you can deduct $1,000, that full deduction amount, as an above the line deduction. So when I use the term above the line, that just means that whether you itemize deductions or not, you can still take this deduction. So it's a nice way to just cover some of those smaller cash donations that you might make to charity, which otherwise would have been kind of lost if unless you itemize. So now for those non-itemizers, itemizers, you can get a little bit of a deduction for charitable contributions. So beyond that, the changes for charitable deductions for people who do itemize, again, this is effective from 2026 and beyond. One of the changes with this new bill now is essentially there's like a 0.5% haircut that's taken from the charitable contributions based on what your adjusted gross income is. So if you're itemizing deductions and you're making charitable contributions, that deduction is only allowed if that deductible contributions exceeds that 0.5% of your adjusted gross income. and that 0.5% subtraction is applied before we look at the maximum deduction based on your AGI. So what that really means is you can take a charitable deduction up to certain limits depending on what you donate. So, for example, if you donate cash to a charity, you can only take a deduction up to 60% of your AGI. So that means if your adjusted gross income was 100,000, and you were to contribute a cash to a charity, you can only deduct up to $60,000. That would be 60% of your AGI. So that 60% mark was increased from what it was previously, which was only 50% before this new rule. So looking at an example might make more sense. So we look at Sam. He has $100,000 of adjusted gross income. He contributes $40,000 of appreciated stock to a public charity. So a deduction of that type is limited to 30% of your AGI. So a moment ago, we were talking about cash. You can donate up to 60% of your AGI, but if you donate something like stock, that's limited to 30% of your AGI. So the way that deduction would get calculated starting next year, that you'd first reduce the contribution by 0.5% of the AGI. So you take the $40,000 contribution and you subtract 0.5% of his AGI, which is 100,000, and that equals $500. So you're really reducing that contribution amount to start with by $500. So now it looks like that charitable contribution is 39,500. Then you have to apply the cap on what you're allowed to deduct based on the type of property that you donated to charity. So in this case, it's stock. So the limit is 30% of your AGI. So it has a $30,000 maximum deduction. So the first part in step one of that calculation, we came up with a contribution amount of 39,500, but step two, we have to max it out at 30,000. Now, in this case, the taxpayer would be able to carry forward not just that 9,500 that's above that $30,000 maximum, but one of the pieces of this new legislation is you can also carry forward that 0.5% of that charitable contribution that was reduced in the first part of that calculation. So now this taxpayer, Sam, can carry over the full $10,000 of his stock donation that was not allowed in the year that he made it. He can carry over that $10,000 up to five years beyond that initial year that he made the contribution. So you still have carryovers, which is nice. But the important takeaway here is that there's a new calculation that applies to charitable contributions based on this new law. And this all starts next year. So one kind of planning item coming out of this new rule is, considering some contributions in 2025 before these new rules start. And you do have those new carryover rules that I just talked about. So kind of boiling down the way these charitable deduction rules work with a couple more examples. Again, this is for folks who itemize. So you're already getting into your Schedule A and you're itemizing all your deductions. Then if you have charitable contributions, you can add those to it. So if your adjusted gross income is 1 million, you at least have to donate over $5,000 before you get any deduction because of that 0.5% haircut that I talked about. So if you were to have AGI of 1 million and you donated 3,000, you'd get no deduction and no carry forward if you were itemizing deductions. If you donate 6,000, you'd have a $1,000 deduction because that's just $1,000 over that sort of $5,000 minimum that you have to get to before you can take a deduction. And again, there'd be no carry forward because you'd be able to fully deduct that in the same year that you make the contribution. So it's basically added a little complexity to the rules for charitable contributions, but once they go into place, I think people will get used to it. But the important point is, again, that the takeaway is that the rules change slightly for next year. So you kind of want to be aware of the rules that are still in place for the rest of 2025, and then the rules that we just went over will take place beginning next year. Talking about some other notable changes to itemized deductions, one of them was related to casualty losses. So losses of personal property as a result of a casualty. Again, this is going to be effective in 2026 and beyond. The existing provision that limits itemized deductions for personal casualty losses to federally declared disasters is now permanent. So that was in effect the last few years, but again, that was set to expire at the end of this year. So that's been now made permanent. And this new law, the big beautiful bill, now expands this rule to apply to losses from state declared disasters as well. So it just sort of expands the amount of situations or type of situations that you can apply this casualty loss deduction to. So this applies to losses that are not compensated by insurance to the extent that the losses exceed 10% of your AGI. So there are some limitations to be aware of related to the casualty loss deduction. Another change for itemized deductions is related to wagering losses. So again, this is effective starting next year and beyond. So for those that like to gamble a lot, you may just need to kind of know when to fold them here a little bit more. The old rule used to be that if you had gambling winnings and you had gambling losses, you could actually offset your gambling winnings by up to 100% if you had gambling losses of the same amount. So you had gambling winnings of $500 and you might have had gambling losses of 500, you could completely offset all those winnings with the same amount of losses. Now, the new rule just says that you can only use 90% of your losses to deduct against your winnings. So it just might leave that little slice of 10% that would be that would result in taxes. We also see that another change to itemized deductions is that qualified residence interest deduction. Most people think of this as, mortgage interest, deducting mortgage interest. So this is effective again for 2026 and beyond. And it's a mortgage interest deduction for that has now been made permanent. So we did see, again, this was made part of that last tax bill that was put in place back at the end of 2017, but this was another provision that was set to expire at the end of this year. This new bill makes it permanent. It's limited to up to $750,000 of debt on the home, and home equity loans are not necessarily included unless the home equity loan was used to build or improve your property. So if you're taking out a home equity loan or a home equity line of credit for doing other things, maybe paying college tuition or buying something else that's not related to the home, then you cannot deduct that home equity loan or home equity line of credit interest that you pay as part of this deduction. So the other new part of this deduction that came into play with this new bill is that now mortgage insurance premiums, most notably known as PMI, are now eligible for this deduction starting in 2026. Before this new bill came out, PMI was not part of what you could deduct. The one of the other things that this act does, it basically permanently eliminates miscellaneous itemized deductions for individual taxpayers. So we used to have some different miscellaneous itemized deductions that you could sort of add to your Schedule A if you were already itemizing your deductions. So those miscellaneous itemized deductions are now going away. Another, probably what I would say would be one of the most confusing parts of this new bill, so I won't go really into the weeds with it. I think I'd give everyone a little bit of a headache, but there is an itemized deduction limitation. So really what that means is, let's say you're already in the world of itemizing your deductions beginning next year and beyond. this itemized deduction limitation would apply to people in the highest tax bracket, so that 37% tax bracket. So what it essentially does is it reduces by about 5.4%, or as the legislation actually is written to say 2/37. And what it essentially amounts to is if you're in that highest tax bracket of 37%, it essentially eliminates the amount that you'd get out of this itemized deductions to 35%. So it's essentially saying that for those people in the highest tax bracket, instead of getting that full 37% deduction when you itemize all of your deductions, if you're in that high tax bracket, you're essentially just going to be capped at 35% for itemized and deductions. So important to note. For folks that are in that high tax bracket. For this year, that's going to be single filers that are making more than 626,000, and for married filing jointly, you have to be up over 751,000 to be in that high tax bracket. So it's going to affect a fairly limited amount of people, but it's worth noting that for those high income earners, there is going to be that kind of limitation on your itemized deduction. So important to be aware of that. There is also now a educator expense deduction that's been made part of itemized deduction. So it's kind of like adding a new itemized deduction, and this will be effective beginning next year and beyond. So no stop date to it, but it expands the types of expenses that meet that deduction criteria. So currently, there's a deduction for educator expenses for people who itemize, but it's limited to $300 or $600 for married spouses who, in the case of married spouses, that they're both educators, so they can take up to $600. That's what's in place currently. But it excludes some expenses for health or physical ed teachers. But so that still applies for 2025. But under the new bill, these limitations would be lifted, allowing educators to potentially deduct more of their out-of-pocket costs for educational materials and supplies. So it's a new deduction allowing K through 12 teachers, counselors, coaches even, and aides, as long as you're working at least $900 per year, you can basically deduct any unreimbursed classroom expenses. So it includes things like books, supplies, equipment. So these now include coaches and sports-related equipment that might be used as well. So the takeaway here, though, however, is that you would need to be itemizing deductions to claim this benefit. So it may still exclude many educators from being able to use this. It would only be for those who are already itemizing deductions. But nice to see this added in as something that some educators can take advantage of. Looking at some tax benefits for parents and families, one of the nice things coming out of this new bill is the increased child tax credit. So this is effective beginning this year, 2025 and beyond. So the child tax credit has now been made permanent, and it increased to $2,200 per child. So again, that was one of the provisions in that last tax bill, but it was set to expire at the end of this year. So this new bill makes it permanent, and it actually bumps it up a little bit from $2,000 per child up to $2,200 per child, and it will be adjusted for inflation beginning next year. So that $2,200 would start to go up, and each year the IRS will let us know what that inflation adjustment is. There is a phase out threshold to this child tax credit. So basically starting at income of $200,000 for single filers, that's where the phase out period starts, and essentially at $240,000, $43,000 for single filers, that this tax credit is completely phased out. Similar for married filing jointly, the phase out starts at $400,000, and once you get income up to $443,000 for married filing jointly, then this tax credit is completely phased out. So at those amounts, there's still a lot of people that can take advantage of it, but just important to know that those phase outs are there. Now, the phase outs, interestingly, are not indexed for inflation. So even though the tax credit itself might go up, the phase outs are not set to increase. The refundable portion of this tax credit does remain at $1,700 per child in 2025. Looking at some other new tax provisions that came out of this bill, some of them were widely talked about before the bill came out. So some of you may have already heard of these. Some gained a lot of notoriety because there was some discussion of these during the election process of things that the different candidates wanted to do. Some of these actually made it into the final tax bill. The first one would be the overtime pay deduction, or what was commonly discussed as the no tax on overtime. So this is one of those deductions that does have a time limit to it. So it's effective beginning this year, 2025. It goes through 2028. It's a below the line deduction, but you don't need to itemize. So essentially, below the line means that it's you can still take it on that kind of first page of your 1040. You don't have to itemize to be able to do this. It's a maximum deduction of $12,500 for single filers and up to $25,000 for folks that are married filing jointly. It does apply to overtime earnings that exceed your normal wage rate. So, for example, if your normal wage is $30 an hour and you get $45 an hour for overtime, then that $15 is eligible for deduction. So there are, like many of these, there are phase outs again. So the phase outs for this deduction start at, if you are a single filer, you make over 150,000, you start into the phase out range. And if you're married filing jointly and you earn over 300,000, then this overtime pay deduction starts to be phased out. Now, employers have to designate the overtime wages on the W-2. There is a kind of a grace period because this does take effect in 2025, and employers obviously weren't necessarily ready for this to be as part of this new bill. In 2025, you're allowed to kind of estimate what your overtime earnings were, but beginning next year through 2028, the employer must actually designate what the overtime wages are on the W-2. So it'll become a little bit easier for taxpayers anyway, because it'll be right on the W-2, making the tax reporting a little bit easier. The other widely publicized deduction coming into this was the no tax on tips. So again, effective same years, 2025 to 2028. Again, it's another below the line deduction, but you don't need to itemize. And the income eligible for deduction here for tips is capped at $25,000 in a single year. So we also have phase outs again that start at $150,000 for single and $300,000 for married filing jointly. So a key takeaway here is remembering that tips and overtime income are still subject to payroll taxes. So Social Security tax, Medicare tax, et cetera. So you might get a deduction on it, but they're still going to be subject to those payroll taxes. Also, auto loan interest kind of came into play here on this new bill. So same effective dates as the other ones that we just talked about, effective from 2025 through 2028. Also, below the line deduction, but you don't need to be a itemizer to get this deduction. You can deduct your deduction is limited to up to $10,000, so qualified interest per year. It doesn't necessarily have to be on one single car loan. It can be on a couple different car loans that you have, provided that they meet the other requirements of this deduction, which is that the vehicle has to have final assembly in the U.S. and the VIN number has to be included on the tax return. So notably, this deduction applies only to interest on new loans that are taken after December 31st of 2024, so starting this year. And the interest on the loans is that any loans that are taken earlier than that, even though your loan might still be in effect in 2025 and beyond, if the loan started prior to 2025, then it's not part of this. So the loans have to be taken out in 2025 or later through 2028. So However, if a existing loan is refinanced in 2025 or later without increasing the balance of the original loan, then the interest on the refinance loan does qualify. So, but by contrast, taking out a new loan on a car that's already paid off would not qualify. So old loans don't qualify, but a refi in 2025 off a existing car loan does qualify, or any new loan does qualify. But again, the car has to have final assembly in the US. And it's only for personal use vehicles. So things like business use vehicles don't apply. And there is a weight limit on the vehicles that apply to this. So essentially the weight limit kind of includes most vehicles that you would think of, except for things like an RV or something heavier like that. So the takeaway here is just there are ways to look up the VIN number on the car to see if it applies. So, with these three new below the line deductions that we just talked about, the no tax on overtime, no tax on tips, and the auto loan, along with that, the new charitable deduction and that age 65 plus deduction, this bill includes 5 new below the line deductions for people who don't itemize. So that's pretty key. And kind of looking at the summary of all this, so existing under the Tax Cut and Jobs Act of 2017, we had the increased standard deduction. Itemized deductions were also in there, as well as the Section 199A, which is a deduction for business owners for their qualified business income, being able to deduct up to 20% of qualified business income. But now under this new bill, it adds all these other things that we've talked about: the age 65 plus deduction, charitable contributions, tips, overtime, and car loan interest. So we've seen 5 new deductions here. So, things that to be aware of that will make tax filing a little bit more interesting. And with many of those, 4 out of 5 of those will start in 2025. And go through 2028, but that charitable contribution one will start next year in 2026. So another change that we saw were some new eligible expenses for 529 plans. 529 plans are accounts that are used primarily to save for education expenses. This new bill has some new eligible expenses that are included in what you can use 529 plans for. So these are effective in 2025 and beyond. And now for K through 12 expenses, you used to only be able to use up to $10,000 a year from a 529 plan. Now you can use up to $20,000 a year from a 529 plan, provided that you do have expenses that are equal to that amount. So for kids that go to private elementary schools and you've got expenses for that, you can now use up to $20,000 from a 529 plan for those K through 12 expenses. You do have some additional qualified expenses that now are a part of that as well. So it can also include some new expenses that can be in play for certain types of students. The other piece of this that was good to expand for 529 plans is some additional expenses for post-secondary school expenses as well. So thinking about college and beyond. So it now includes expenses for tuition, books, and fees or supplies for enrollment or completion in certain post-secondary credential programs. So think about after someone graduates, they're in a profession where you might need to get a certain designation. Many financial advisors have these where you have to go out and get continuing ed and pay for that. So now you can actually use 529 plan assets to pay for those types of things. So that was not something that was ever part of 529 plans for people that were paying for their professional designation. So there may be some parents out there that have leftover 529 plan assets after their kids graduate. They may be in a situation where they're needing to pay for their own professional designations. They can start to use some 529 plan assets for that. So this new act created a new type of savings account for children under 18. It's the so-called Trump accounts. They're technically child savings accounts, but they've been kind of referred to popularly as these Trump accounts. And children under 18 can have one of these accounts open for them, but only those that are born between the years 2025 to 2028 will actually receive a $1,000 initial deposit from the government that will be automatically contributed to their accounts. But anyone under age 18 can open one of these accounts. But anyone born in those years will actually have some seed money of $1,000 put into these accounts. So child must be a U.S. citizen to receive that funding. And the account will be automatically created if the account is not previously created by the parents. There is an opt-out provision if parents want to opt out. For those that are not born in those years and not getting that automatic contribution, if you're under 18, parents can still open these accounts. There's a contribution limit of $5,000 per year. It'll be adjusted for inflation after 2027, but for the start of these, it'll be $5,000 per year. Employers can also contribute up to $2,500 a year, and that's not taxable to the employee if the employer makes that contribution. However, that employer contribution does count towards that overall $5,000 limit. Continuing with these same accounts, the contributions are allowed up to the year before the child turns 18, and the contributions are not tax deductible. So the contributions kind of go in after tax, which is, similar to 529 plans, similar to Roth IRAs. The contribution money is going in there after tax. So you can't get a tax deduction for money that's contributed. But the accounts do grow tax deferred until they're withdrawn. But withdrawals aren't permitted until the year that the child turns 18. And a couple of other smaller provisions on this, just to be aware of. The investments in these accounts are limited to funds that track a U.S. equity index, and the investments have to have fees of less than 0.1% a year or less. Now, once the child turns 18, the control of the account does pass to the child. So certainly an important item to keep in mind there. The parent can't continue to, control the account. So the account is kind of turned over to the child. And the direct contributions, meaning contributions by a family member or the employer of the account holder, those are not taxable when withdrawn. But capital gains are applied on withdrawals as long as they come out for a qualified expense, which could be for education, first-time home purchase, that sort of thing. There can be regular income tax and additional penalty that's applied on withdrawals for things that are not a qualified expense. So just be aware there are some rules related to these accounts that apply to how money comes out of them. And the takeaway for these types of accounts, we're still kind of waiting on a little bit more information from the IRS on exactly how these accounts will be treated. So there's a possibility that I'm seeing some things that I've talked about. There could be some required minimum distributions that start from these accounts as early as age 18 once the child takes control of the account. So a question that's started to arise is, how do these Trump accounts compare to other accounts that help kids save for the future? It's really going to depend on what the goal is for those funds. So the challenge to this point is that existing options for parents to save on their child's behalf all have kind of drawbacks of one kind or another, or pros and cons. But accounts like a traditional Roth IRA requires that the contributor to have earned income. So whether parents are contributing to a Roth IRA for their children, the children still need to have earned income. So taxable custodial accounts, things like UTMAs, those are transferred in full to the child at the age of mostly age 18 or age 21. So there's no way to ensure the funds are actually used for retirement or something later on. And then 529 plans have a lot of good advantages to them, but they're they're most widely used to pay for education expenses. You can use them for something else, but you would pay tax and a penalty on the gain. So, we still don't know exactly how some of these Trump accounts will interact with other traditional or Roth IRAs. So still waiting for some information to come out on that. But other than the initial $1,000 government contribution on those Trump accounts, there really are not a lot of unique features with those Trump accounts. So it's not necessarily something where we would say, okay, for any families with young children, let's go ahead and jump on those accounts. It really will kind of depend on what the money is intended to be used for. So it's important to kind of discuss these other account types before you jump into that type of an account. All of these have pros and cons. So just important to kind of discuss what the goals are for the money, and then we can arrive at what account makes sense. So one of the biggest changes in this new tax bill is the permanent expansion of the federal estate tax exemption amount. So a lot has been made of this. Those of us in the financial planning community have been watching this very closely. So what was originally a temporary provision in that 2017 Tax and Cuts Job Act is now sort of a lasting part of the tax code. So starting in 2026, the federal estate tax exemption amount will increase from the current level of 13.99 million to 15 million per person, with annual adjustments for inflation moving forward. So for wealthy families, that means a married couple can transfer up to $30 million tax-free without really having to kind of, I guess, worry or think about that looming expiration date. So a lot of us in the financial planning community have been looking at this kind of deadline, so to speak, where if this new tax bill didn't get passed, then that exemption amount would have been set to sunset at the end of 2025, meaning that it would revert to the exemption amount that was in place under the old tax bill, which put it at 10 million, but then it increased. So really what that means is for many people it thought that exemption amount would almost be cut in half from that 13.99 where we are this year to something around 7 million. So now we don't have to worry about that. It's increased beginning next year at 15 million per person. So we have no more clock ticking, so to speak, on the sunset of this. But while that expanded exemption amount is now permanent, it's important to remember that permanence in tax law is never truly guaranteed. So I've used the word permanent a lot of times in our discussion today, but it's only as permanent as the tax law remains in place, and new legislation could come out in the future that is changing anything. So anytime you see or read the word permanent in any of this, it means that it just doesn't have a set end date. It's going to be in place until new legislation comes out and changes it. So important to keep that in mind. The other thing is, don't forget about state estate taxes. So here in Massachusetts, the exemption amount is much smaller at $2 million per person. So you get a much larger break at the federal level, but there are some states like Massachusetts that have a smaller exemption amount. So you want to be careful before you start unwinding some estate planning that you may have done, thinking that exemption amount was going to shrink at the federal level. Before you start to make any changes, it's really important to just consider that at the state level, you might still be subjected to estate taxes at a smaller exemption amount level. So you may still want to be mindful of some strategies that will help to work with the state level estate tax in your state. So important to keep that in mind, especially for folks that we mostly work with here in our home state. One of the one of the few things that was part of this new bill is looking at some ways to pay for all these things. So whenever there's legislation that's working its way through Congress, through the House and the Senate, usually the back and forth is really around, okay, if we're going to provide some tax breaks, then what are we going to use on the other side to sort of pay for those tax breaks? So one of the things that we did see coming into play with this new bill is the repeal of some clean energy credits. So the termination of the electric vehicle credit, which was 7,500 for new vehicles, 4,000 for used. That now expires that in September 30th of 2025. So not too far from now, instead of actually being in place all the way to the end of 2032. Similarly, the termination of the alternative fuel vehicle refueling property credit. That's sort of a long way of saying like electric vehicle charging equipment for home use. That now expires June 30th of 2026 instead of, again, going all the way out to the end of 2032. Same with the termination of the energy efficient home improvement credit. That does expire at the end of this year instead of the end of 2032, and the termination of the residential clean energy credit. So think of like installation of solar panels, heat pumps, that expires at the end of this year instead of at the end of 2034. So that was really a big rollback on that. So the key thing there is to kind of be aware of these deadlines. And, for anyone that may be already in discussion about installation of solar panels or looking at things related to the electric vehicle credit, a lot of those rollbacks are going to affect folks that are looking at items like that. Now, with something like the residential clean energy credit, like the solar panels, for example, if the solar panels are installed and put into use by the end of 2025, you are still able to get that credit. So kind of looking at some planning considerations here, we've talked about a lot of different things. Unlike that Tax Cut and Jobs Act, which wasn't passed until late December of 2017, that was just days before most of the provisions took effect. There's still plenty of time left before the end of the year for much of this new bill's impact. So some end of year planning opportunities that immediately stand out. For example, it could be beneficial to make any large planned charitable contributions in 2025 rather than 2026, when in 2026, remember that 0.5% of AGI floor on deductible contributions goes into effect. Likewise, for employees with unexercised incentive stock options, ISOs, that could trigger AMT. It may make sense to exercise those ISOs prior to 2026 when this new tax bill's lower AMT exemption amount threshold. It basically faster phase out rate kicks in. So if you have ISOs, probably important to take a look at those, and maybe there's some planning around exercising some of those because of the AMT. There are going to be obviously other considerations that will come into play with exercising ISOs. So, but that's just something to kind of put on radar for something that might want to be done before year end. And really, anyone planning on, like I was just saying, making purchases or upgrades that would qualify for the Inflation Reduction Act on the clean energy credits, important to kind of just be mindful of those dates that I talked about. So the things with estate planning, there may be some estate planning that was already done, like I said, thinking that the estate exemption amount was going to be lowered. So folks that had put some assets into trusts that were really designed to work with a smaller exemption amount, it may make sense to move those into different trusts. Things like purchasing life insurance out of an irrevocable life insurance trust, for example, maybe that ILIT isn't really needed anymore because of that higher exemption amount. It's possible to kind of purchase insurance out of the ILIT and still have that insurance in place for other needs. But again, we do want to be mindful of planning for smaller exemptions at the state level. And really just kind of wrap up by saying kind of mind the phase outs. So you definitely have potential higher taxes for income in that $500,000 to $600,000 $100,000 range, just because of the way some of these phase outs kick in and the way that you can be limited to deductions once you get into those income areas. So we covered a lot today, but just kind of be aware of when you're thinking about different deductions. Some of these will be in play for the next couple of years. Some of them don't start until next year. Some of them will be gone by 2029 or 2030. So, at Stonehearth, we're going to work with clients just to make sure that any of these levers that we're pulling on some of these deductions that we think we can take, we're going to be mindful of if you pull one lever to take a deduction, it might affect something else that we're doing. So we're going to always want to be mindful of that. But this is, an important piece of legislation that came out, and there's going to be a lot of items to be aware of on your personal income taxes. So I'll wrap it up there. Thanks for everyone who listened in today, and I really appreciate you joining us today. We do have some time for questions, Amanda. I don't know if there's any questions that have come up.
Hi, David. We do have a couple, so thank you for all that. I know we went a little bit over than we had expected to, but it is a lot of information. So thanks for everyone who hung in there. We'll just with what time allows, we'll answer a couple of them, and then if we don't get to your question, David or myself will reach out to you after the webinar, make sure we get your question answered. The first one I have here is, are there any major surprises in the bill that maybe advisors or taxpayers might be overlooking?
Yeah, no real major surprises, would say. I think one of the things was something I talked about related to that Social Security income. I think a lot of people were kind of thinking about this. Oh, my Social Security income's not going to be taxed. So we covered that. No changes to Social Security income. And then the other surprises are just, being mindful of those clean energy credits that will expire, a lot of them either at the end of September or end of this year.
I think you actually maybe just answered this one. Does this legislation change the way we should approach Social Security or retirement income planning? But I'm guessing that's a no.
Yeah, it really, what we would really look at are, situations where if you're over 65, you've got that additional deduction you can take. So, no, not really necessarily any changes, but as it relates to being able to take some additional deductions, just looking at things like if we are doing a Roth conversion, we want to make sure that because of these phase outs, if we're trying to take certain deductions, we may want to be really controlled about how much of a Roth conversion that we do, for example, because we don't want to push your adjusted gross income up too high and possibly preclude you from taking some of those new deductions that we want to take. So again, we don't want to pull one lever and then end up, kind of sacrificing some other tax planning strategies that we're trying to put in place.
David, we do have a couple more, but I think we're going to wrap it up with this one. What do you think is the most misunderstood aspect of the big, beautiful tax bill?
Misunderstood. Yeah, I think, again, a lot of people thought Social Security income would be part of this. So we covered that. I think another thing would be that a lot of times the word permanence is being used, but as we saw when we went through this, some of these only have a range of 3 to 4 years. So that I think, from folks that I've talked to, that there's this idea of the word permanence being used, but not everything is permanent in this bill. So really important to just be mindful of the dates and the timing.
Awesome. Well, thank you so much for joining us today. We hope that all the attendees found the session to be really informative and helpful as we kind of navigate those upcoming changes to the tax landscape. I just want to remind everyone you can feel free to visit our website. It's right here on the screen, www.stonehearthcapital.com. You can find a variety of helpful resources. We have a lot of new blog posts, financial planning guides, and tools that might support, your personal and business planning goals. We also encourage you to check out upcoming webinars. We continue to break down financial topics, legislative updates, and all the planning opportunities to help keep you informed. And as always, if you have specific questions or would like to speak with anyone from our team, you can reach out to us directly. We're always happy to help. So thank you, David. Thanks again, everyone, for spending part of your day with us. And we hope you have a great rest of the afternoon.